Hi, and welcome to Lever Brothers tutorial on descending triangles. Descending triangles form in downtrends and are characterized by a series of lower highs but the same lows. They have a definite bearish bias and typically form in 2 to 8 weeks. It's as if a massive buy order has been placed at the lower trend line, and even though the stock is weak and in a downtrend, it takes some time to fully execute the order. Once the underneath demand is absorbed, a big drop in the stock can occur because the lack of demand shifts the supply-demand imbalance to favor the sellers. The best breakdowns occur 1/2 to 3/4 of the way through the pattern. Breakdowns that are delayed until prices crowd into the apex usually fail or are mediocre at best. If by chance a stock trades above resistance, it's not always a reason to go long. Instead, the trader ought to simply redraw the trend line and keep watching for an eventual break to the downside. It's not uncommon for a descending triangle to morph into a rectangle. This act of redrawing a trend line is pretty common because drawing trend lines is a subjective art at best. They are the trader's best guess as to where support and resistance could be or should be, so redrawing them is permissible. Volume usually diminishes as a pattern develops, but like other downside breaks, there is no strict volume requirement. The best downside breaks occur on average volume followed by the stock drifting lower for a few days. Volume then ramps up as traders throw in the towel and the stock falls hard. There are a couple methods used to determine the expected price movement. 1. The widest part of the triangle will dictate the price movement out of the pattern. 2. Price movement will equal the move into the pattern. And 3. Price movement will be contained by a trend line drawn parallel to resistance and through the low of the triangle. Let's go through a couple of examples to highlight these principles. Here's AES. The stock had been steadily trending down when it formed a descending triangle with support just below 34. Notice how volume ramped up as the stock fell. That's exactly what you want to see. Huge volume surges during the breakdown often signal capitulation, so it's better to get a slightly delayed increase in volume. The move into the pattern accurately identified a level where the selling pressure would run out of steam. Here's Amcor. The stock made a series of lower highs and lower lows and then traded into a descending triangle with support at 15. Notice how volume did not surge when the stock broke down, but did ramp up the following couple of weeks. That's exactly what you want to see. The size of the pattern was 5 points, so that was the expected move down. And, as a nice confirmation, a line drawn parallel to resistance also projected a move to the 10 area. Here's CTV. The stock steadily trended down before trading into a tight descending triangle. The pattern was on the smaller side and didn't have many distinct touches, but it was still valid nonetheless. Volume was slightly above average on the breakdown, and then it ramped up as the stock continued to sell off. The size of the pattern was too conservative, determining a downside target, while the move into the pattern was too aggressive. This isn't that uncommon for a low-priced stock. You can't expect a stock to fall into penny stock land just because it breaks support. We have found anticipating a move based on the size of a pattern or the move into the pattern works much better with expensive stocks than with cheap stocks. Let's quickly go through a few more. We find it helpful to look at successful pattern formations to train our eyes. Here's Atmel. Obvious pattern with easily definable support. The stock broke down and then volume ramped up as it continued to fall. BMC, textbook continuation play to the downside. Bob Evans. This is a situation which isn't too uncommon. The stock broke down from an easily definable descending triangle pattern, and after falling for several days, it traded into a bear flag. Once the new pattern starts to form, it holds the key, and any expectations from the previous pattern need to be abandoned. That wraps up this tutorial. Again, descending triangles are pauses within downtrends and have a definite bearish bias. Ideally, volume is average when the support is taken out, but then ramps up as the stock continues to fall.